Hello, 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 dear friends. This is your friend Vivek Bajaj, co-founder StockEdge and Elearnmarkets. Welcome to yet another face-to-face global, and this one is also going to blow your mind. Well, you know what is happening in Russia, Ukraine, and so much happening globally. And one financial asset which has really caught attention, of course, crude oil. And after crude oil, gold. So gold is a very fascinating instrument, and I'm so happy that when I started my career as a commodity analyst, I started with analysis of gold and crude oil because both are pretty much related. So from here, $2,000 to where, up or down, and what are the things we should know about gold and silver? And if you are active trader, then you don't want to miss this because this long interaction with amazing guests is going to give you 100% paisa vasool about gold and silver. So let me welcome my guest, someone who is there on Twitter. I follow him. He's quite active there. And when I talk about gold and silver, people say that you have to talk to Patrick about it. So Patrick Karim. Hello, Patrick.
Hello, Vivek. It's a true honor that you reached out to me there. It's like when I saw the everything you've done, man, I said, oh my God, what have I got myself into there? I'm scared now.
Not at all. Please don't be scared because, I'm blessed to have friends like you whom I connect, and Almighty is very helpful that he allows me to connect with people like you. So Patrick,
Cool.
I'm a big follower of your tweets, and I feel that you know gold and silver quite well. There is something between you and gold which is going on. What is it? What kind of affair it is?
Well, okay. So gold, guys, if I could take just a little bit step back there, gold essentially for my research at the beginning, we deep dive. I started following gold in like say 2018 when I saw it was breaking out against other world currencies because everybody looks at gold price in US dollar. But then in 2018, it was already breaking out versus Australian dollar versus Canadian dollar. And then I said, okay, something special happening. I kind of felt that I had an edge because I said eventually all fiat currencies, they're debased eventually. And in forex pairs, when you compare two currencies, you can't really see that they're both going down because you're comparing one versus the other. And then in 2019, in June of 2019, gold closed above 1350. It was a huge base. It did from the 2013 down all the way. And then this opened the gateways. Everything we're seeing today, guys, forget the headline news, like let's say Ukraine and all that. There was no news in 2019, but gold decided to break out and it actually opened the gateways. It was sniffing out the eventual loss of purchasing power for the American people, the people holding US dollars. And that was a game changer. So gold rose like crazy from 2019 all the way to the highs in 2020. Even during March Madness, I call, in March when everything dipped. If you look on the quarterly chart or monthly close chart, you can't even see the March dip. It's on the line chart. It just kept going up and up. And that opened the gateways for everything else, what you saw in oil, what you're about to see in silver, and all the other commodities. They looked at gold and said, gold sniffing out this inflation, and they after the races they went there.
So we are going to talk about all these things, and obviously you're going to share the chart and what are the factors which influence the gold, etc. But we want to know about you. So tell us, Patrick. I believe you are in Canada, and what's your history like? What made you get into this?
Well, look, like a lot of investors in 2006, I started early 20, mid 20s, late 20s, trying to have some money. And then I said, I have to start investing. And in my DNA, I'm like a contrarian. I never really liked giving, let's say, a financial advisor to take care of my money. I didn't suspect it, but I felt that I could, have an analytical mind. Like my background, just to tell you guys, I'm a Linux system administrator. That's what I've been doing for 20 years. So I always like to think, analyze, crunch the numbers and all that. And then I wanted to start investing in 2006. Then I went on, like everybody, they Google what stocks to buy, but you always find the scams, the penny stock forums. That's the first thing people find before you find true value. Like, let's say your website, or it's hard for people because on Google, you'll find the easy stuff. It's like, I remember one time I lived in Paris for a few years. And what I've learned is the first restaurants you see when you come out from the Champs-Elysees, those are the tourist traps. Never go those. The best restaurants, you need friends to tell you where the good resources are.
Yeah.
And after that, I was so lucky. Like, I didn't wipe out all my savings in my first years, because in hindsight, like today, when I looked at the charts of the stocks I bought on the penny forums, I was buying at the top. Because this is another thing. When you hear about something, it's probably too late. Because if your neighbor at the water cooler at work tells you about Bitcoin or whatever it is, the reputation, why they're talking about it, is because of previous gains. If you want to be a contrarian investor and buy when nobody's talking about something where you could position yourself early, this is where you want to be, because as it goes up, each drawdown, it's higher lows. So technical analysis, I fell in love with it. I read my first book. It was Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. So if any of your readers, they want to get a head start, that's where I learned that fundamentals, they don't really matter. Or if they do matter, it doesn't. All the analysts that have fundamental stories, they'll eventually push their money and they'll buy and sell, right? So the theory is I'll see everything in the chart, and that really appeased to me, and I really grew into it. And like any trait, any professional, the more charts you look, the more, like, I don't know how many charts I saw. Then you see the patterns, the fractals, the analogs repeat, and then you see how other experts they incorporate this human behavior that you see in the charts, and then after that you take up bits and parts of that and you create your own trading framework. Because what I've learned, like, I'm a super emotional guy, Vivek, and even if chart trading seems kind of binary, you buy here, sell here, the metrics, but I'm constantly fighting my emotion side. I'm super emotional, and usually that's probably the toughest part. So it's a constant battle, and that's what I kind of like chart trading is. I get emotional. Oh, silver, gold's going up, but then I look at the chart and I say, okay, this is just the beginning of a long-term trend. There will be pullbacks to the moving averages as it's going up. I will feel awful, I'll get the trolls on Twitter saying, Patrick, you're not good, But the more you face those fears, the more you digest that, when they happen, it's okay. It's not a shock, And this is another thing I like. Guys, if you decide to follow somebody, it says buy or sell, that's super dangerous, because if you do that and you haven't done your homework, as soon as there's a drawdown, you're emotionally trapped, because you have no base, to fall upon when there's a price action that goes back down. So I might have went offline, but that's pretty much how I rolled into this. Once you do technical analysis, it's hard to go back to just doing fundamentals, because now you see the true picture behind the scenes. It's the actual price action that you could play, right?
Sure. Absolutely. Well, I think that's pretty much there, that once you learn technicals and once you're into technicals, you can't do anything, not just fundamental. You just fell in love with market and price movement so much that you don't want to do anything in life, isn't it?
Oh, pretty much, because I spent, look, if you love what you do, it's not work, people, I wish this upon anybody, to be able to wake up in the morning. The first thing that comes to mind, I dream of charts and I have to write it down. I say, I have to post this chart to our members or to Twitter. And it's like a reflex, and the more you study the charts, the more you see the patterns, the more you have ideas, and it's unlimited happiness, and hopefully it gives value to people who watch your work, just like you do with your interviews, and people, you love doing it, and then people, they see you love doing it, you extract value, and people, they just it helps them a lot, because the best thing I wish is for people not to go in the penny stock forums like I did in those penny stock scams, that they could skip the noise and they could come straight to me or to you, and to at least have a more like scientific approach, more logical basis to manage their own finances.
Yep, absolutely. So let's go deep dive into gold and silver.
All
Let's
right.
start with gold first, and I'm sure you're going to share the screen, and we're going to see the charts, and we're going to do all kind of talk.
Okay, there's one great chart I did recently. Let me scroll down. It's very where is it?
So by the way, guys, this is Patrick's Twitter handle. So if you are interested in gold and silver and what is happening in macro globally, this is his handle to be followed.
Bear with me, guys. This is I do so many charts, and here's the.
How many charts do you see every day? How much time do you spend on chart analysis every day?
I can't. I don't know if I can't count. It's so, because every time I see a chart now, it's so much of an instinct. I kind of like see the lines already before I draw them. I already see them, and then I see the pattern. I could tell pretty much right away if this has been consolidating for a long time, if it's about to turn up. Because I remember at the beginning, for any chart trader who starts, it's super tough at the beginning, because you say, okay, do I have to connect the lines to the wicks, to the candles? But over time, you realize that it doesn't really matter, because it's like human emotions. It's not binary. It's areas of support, areas of resistance. You have to be more, it's more of an art. You need to be able to float around with it. By the beginning, you want the chart to tell you precisely what to do, but it's not quite that. You have to look at the chart. So let's say here I have gold charts. Here, let's start with this one, Vivek.
Okay.
This gold chart, you always have the regular, let's say, gold chart that everybody sees. But then if you want to see how well it's performing versus other assets,
Okay.
you have to start measuring it into something else. On this chart, guys, I measured gold in US minimum wages. So my theory or my logic is, I want to know that people, minimum earners, the one who gets the minimum amount from the government, are they getting poorer or richer? And if you gold is able to outpace the minimum wage, it's telling you that your purchasing power for like a bulk of the population is getting decreased. So there's inflation coming in, but the minimum wage is not able to support. So essentially, you're getting poorer and poorer, and this is not good. This is like, I don't know. It's a difficult spiral to get out of. But when gold starts outperforming the minimum wage, look, I don't know. Like, I call this the pitchfork chart, Vivek. It's when people, they get really angry, and when they can't buy food anymore, and they come out with their pitchforks to the government and say, "Hey, what are you doing, guys?" And look at this here. Okay, here's a gold price chart. Fine. This is quarterly chart, clear breakout levels here versus when it's priced in the minimum wage. So we had a clear breakout here, exploded, came to retest this breakout line, and now it's exploding above this, what we call a bull flag. So pole, flag, and usually the measured move is the distance from the bottom of the pole all the way to the top. You add it here, and then after that, you have a measured move much higher. So this is projecting that gold should keep outpacing minimum wage for the next couple of years, which is kind of scary. At the bottom right here, guys, I have the 7-year rate of change. So here it says 28 periods, but it's 28 periods of the 3-month quarterly candles. This is a basic premise of chart trading, guys. It's fractals. It's human behavior repeating over and over. That's why it works. If I know I'm here today as a chart trader, I'm going to try to see previously in the past history, and this was great about gold, is I have like 40, 50 years of data. What happened every time I came from below negative rate of change above the 7-year EMA of the rate of change? What happened before? Guy, look, we're back in the 70s. All this inflation period, all this craziness that happened in the 70s. We're right about here, 2004, just when we had this inflation period, when precious metals, they outpaced minimum wages, when they outpaced the US equities. And look, Vivek, this is, I have shivers every time I look at this chart. We're just starting a new cycle. And these cycles, they last 7 years exactly. So here I have 7 years. So the momentum It took 7 years to wind up until there's exuberance. And then after that, from peak to valley, it took about 7 years exactly to unwind that momentum. Then you go into a bear market. You see, you never went above the EMA here. And then when you broke out above here, that was like the wake-up call, just like in 2019 when I told you, when gold woke up way before all this talk today of inflation, way before crazy gas prices. These changes in momentum, they're macro vectors. It's not, and this, I had this another chart I have to show you after, is everything's financialized. Since 1971, since we went off the gold standard, you'll see, guys, forget manipulation. If you use a word like manipulation, you're taking the control that you might have and you're giving it to somebody. You're blaming JP Morgan, you're blaming comics. There's no advantage to blame anybody. You're, as a chart trader, just look at the chart and you'll see the advantages, the skewed risk versus reward in your favor happening here. It's just turning the corner right here. So when you see that, it's like your kids, or a kid that behaves properly, or they have cycles, or let's say in the morning they brush their teeth and they do this. This is a new cycle where your kids are going to brush their teeth in the morning there, and you know exactly. Okay, it's a high probability of this possible move. Right now, I have to view it as a high probability of working out as it previously did here, as it previously did here. And as a chart trader, if ever it breaks down, of course we're going to revise the game plan. We're going to say, okay, something changed. But until here, you know that you're buying low. And whenever it gets super stretched here, that's when you hear about the water cooler talk, Vivek. That's when you're going to hear about your friends. Hey guys, maybe we should buy gold, But you're going to look at the chart and say, oh, no, I'm sorry. This is, we're approaching the end of the cycle. We're deep in. The momentum slowing down, right? Because you see, this is higher lows on the momentum. So even the way I see momentum, guys, is you're running up a hill. At the beginning, it's easy, right? You're flat. There's no hill in front of you. You get a lot of speed. As you go up the hill, you can still go up fast, right? But the higher you go up the hill, you can't run as fast, right? You slow down. So even if the price action kept going up, kept outpacing minimum wages, the momentum was not able to do a new higher high. It's called, you call that also bearish divergence. That in itself is not a reason to go out. But once you close below a valid trend line here, and you need 3 dots, guys, 3 touches, break on the 4th is confirmed. So here, 1, 2, 3, break on the 4th. And then you break from the stop formation, you break from the EMA. You had a great signal to exit the gold right here, guys. And this is, okay, yeah.
So sorry to interrupt you, Patrick, in the middle. So this basically, the ROC which you have plotted is ROC of that ratio in the top. That ratio has numerator as gold and denominator as the US minimum wages.
Exactly.
Now, if suppose US minimum wages also goes up, then and gold prices remains there, then this chart will obviously go down, and the ROC chart will also see the impact. So why do you measure the ROC of that relativity? Why not ROC of that gold chart itself?
Okay, well, yeah, because I've done I'll show you the gold chart. So we could, yeah, it's all about the weight of evidence. I might have jumped a spot, so we'll do directly to the gold chart.
Sure.
But if the gold chart, it looks even better than this, Vivek. We'll do it right now because your point is great. If the gold chart, the rate of change is exploding up, and then gold price in other things, because remember, gold could go up, but if it's not going up as fast as US equities, if it's not going up as fast as minimum wages, then it's not the best asset for you right now, right? So let me get you gold, and this, I'll draw it, remove drawings. I'll do it for you guys right here live. Okay, here it is. So here, guys, this is the gold chart right here. So let's forget the price action. We just want to situate ourselves in time, right? It's right here. It looks pretty much like the one in minimum wage, right? It's right here. It's right. Oof, yeah, maybe somewhere here, right? Right above. It's kind of tricky because before 1971, it was pegged, the US dollar. So it kind of cheats the charts. But you can see historically that we're really, really just beginning a new cycle, guys, for gold. 84. Here's 84 periods. It takes exactly 7 years to unwind the right here. Look at that, perfect 7 years, Vivek, to top out on momentum. So I'm not quite sure where. Depends where you decide to put this, but I have a lot of targets for gold. That you should hold your gold at least until 2028. Of course, I think we have cycle analysis where there could be a drawdown in 2024, but the bulk of this move, gold, guys, it's scary to see there, but people following right now on your channel watching this that don't have any idea of what's happening to gold, because everybody's been talking about US equities, tech stocks, all these all these growth stocks, that loved low inflation. Look at this pole flag right below breakout line. It's some people, I think they've seen the inverse head and shoulders here, but it's breaking out, Vivek. It's going to be tough to come back. So the probabilities as a scientist or whatever you want to call it, as a chart trader, you have the trend is your friend. This is a paradigm shift that is based on 7-year rate of change. It's not going to be overturned that easily. Like you've seen here, look, even here it respected the 7 EMA, didn't never get above. Here he had the wake up call in 2003. I think we should be in quite a ride for gold.
Sure. So Patrick, this gold chart which you are showing is obviously vis-a-vis US dollar. So is the structure is going to be the same if we take any other currency, or your judgment could be different for each individual currencies?
Well, look, yes. So I could do the
do INR. I'm just fancying.
Exactly. So let's say I put it in the Indian rupee.
Yeah.
Let's do it, guys. Don't be scared. Your purchasing power. Let's see if it's going to survive.
Oh no, we are anyways going to buy, so don't worry about it. We are in love with gold, so irrespective of what it will happen here.
I don't have a lot of data for the Indian. Hold on. Oh, yes, I do have more data. Let me just choose the better time frame. There you go. Look, this is the first time I look at this chart. So this is a premiere. We're gonna chart review.
Yeah.
Together.
This is what I do.
Look at this, guys. So this is the Indian rupee, and it's getting the signal. Also, it's breaking out. So gold, not just the US dollar, but it's breaking. I like stretching a line whenever I see a price action testing multiple times. Stretch it out, guys, and you'll see that it happened. It's a pivot line. It's not magic. Even look at that perfect retouch.
Yeah.
Pivot line here. Here it played a little bit before going back down. Here, not quite so. Here, so you see these reaction points on here. And it's time to go long gold in Indian rupee. So whatever you have as not financial advice, guys, but you're entering a cycle right now that, let's see if it's 84 or just about. You're entering a cycle where the Indian rupee should get devaluated versus gold. So I don't know what your government's doing, but it's probably printing money, right?
Oh, government has its own priorities right now.
This is scary stuff, man.
No, but the problem with India is that we are net importers of gold. So our current account deficit will see a lot of problem. And, I want to touch that point also, that when you are making, because I see you are looking at monthly and quarterly, so their fundamentals plays an important role. Do you also plot US economy, overall macro variables with gold to make a macro judgment on gold?
Yeah. Look, I've compared gold. I'll show you. Okay, I'll do it right now.
Sorry, I have this bad habit of interrupting in the middle, so please don't mind.
No, it's great. I love it because your questions are the thoughts that probably your viewers, they're probably asking them the self question. Because when you deep dive gold, then the first reflex is you want to see, okay, I want to see, okay, what moves gold? And then you start looking at ratios. You compare gold to SPX, gold to the US dollar. So here, first thing you could do is you look at the US dollar, and then I'll add gold. And what I could do is I could actually flip the price of gold to make it inverse scales. So now it's inverted. So now you see, okay, gold, it tracks the US dollar, but the correlation is not nice. You see here, there's a spike in the US dollar in the 1980s. Gold went up a little bit or down a little bit because it's inverted. But then one day I did gold, but let's say I'm going to inflation adjust the gold. So I'll compare it to I'll measure it in producer price index. I like the PPIA CO guys, because the producer price index is the actual input cost of all producers. How much does the wheat cost for the farmer? How much does the oil cost? And there's no hedonics like they did for the regular CPI in the United States, where I think in 1982 they played around with the basket. I think in 1990 they played around the basket. And look at this. So here, remove drawings. Reset chart. Look how better it tracks now. So for me, this is the best correlation I've ever saw to the gold chart. Is gold tracks your purchasing power. So if you could try to rationalize the inflation adjusted US dollar, so let's say you held the US dollar over all these years, gold loves tracking that. So whatever influences the inflation, whatever influence the negative rates, the rates, whatever, or the US dollar versus other currencies, right? Because the DXY is just a basket. It's a US dollar versus 60% euro, Great British pound. So all these macros, everything that's mixed up together, if you bring it down to one chart, for me, this is the ultimate chart. And right here, okay, guys, the black line is the ratio for, hold on, check it out. Right here, I have a clear breakdown.
So what is this black line suggesting for dollar?
Yeah, the black line is the US dollar adjusted for inflation.
So what is it suggesting right now? The dollar, should it go down, or based on that?
Well, remember, it's a ratio. So it could be a combination of things. So for this ratio to keep going down and for gold to keep going up, the US dollar could actually be going up, Vivek. But if there's so much more inflation that when you adjust for inflation, the US dollar, and this chart makes it go down, look, I'll put the DXY on top for you guys.
Awesome. I'm loving this interaction, Patrick. This is giving so much different dimension to our analysis.
Check this out. Because people are scared. I'm long gold, I'm long commodities, but the US dollar is exploding, and this is the US dollar going up, Vivek. See, everybody right now, they should think, hey, gold should be tanking. It should be at 1,600, but it's not, because there's so much inflation that when you adjust inflation for this period here, the actual chart, that's how it looks like. And gold is actually tracking this way more than US dollar. Look, if the US dollar, to come back to your question, if the US dollar tanks by itself, so let's say versus the euro, they decide to raise their interest rates in the Europe community, and the DXY drops, it's just going to make it drop even more. You could also have inflation going flat, or instead of being -5 or 6 or 7% inflation, let's say it goes down to -2, but the DXY stays flat or doesn't go up more than 2%, then this chart will also be getting dragged downwards. So here you go, guys. Here's the gold chart. So even during this period right here, I'll do so even if the DXY is going up right here, you see gold going down because gold is tracking the inflation adjusted one. And before you ask me the tricky question, I'll show you what happened in 2019 when it broke out. 2019, June, right here. Okay, I'll try to clean this up.
So this gold price is the inverse price, right?
Yeah, it's inverse. I'll put it the regular way. Maybe it's confusing.
So so you just said that, so dollar goes up and obviously gold will go down. But in this scenario, what has happened? Inflation adjusted dollar has gone up and gold has also gone up. No, exactly. The other way around. Sorry, the other way around. Yeah.
Yeah, it's sniffing it out. Look in 2019 there, the US dollar was going up. No, it's right here. The US dollar was going up and it kept going up, but gold kept going up with the US dollar right here. See this small period when the gold, people said, hey, this is wrong, but gold was actually 6 months ahead. I'm going to put and it was 10 months ahead. It was sniffing out already that US dollar was about to turn down nominally, but more importantly, it was about to turn down inflation adjusted. And this is when all the commodities started going up, wheat, oil, everything else. And that's what's in the PPI ACO there. It's like all commodities, input costs. So gold that's why I come back to the first thing I said, it's the gateway. It's telling you if there's going to be a next leg up in inflation for everything, or if gold breaks down, it's closing the doors for everything else. And it tells you more than that. It tells you that if gold is closing the door for commodities, that means now you have to look at growth stocks. You have to go back to US equities, to NASDAQ or wherever, and then you have to start putting your money there, because eventually this will burn itself out, and you could still own gold to preserve your purchasing power, but you won't want to own gold miners, those leverage products. You're not going to want to own any of that when this breaks down. This is the key to know where your portfolio going forward, how you should start seeing like the change that's happening. And right now, guys, if you see gold, look, it's breaking out of this pole flag. So let's do pole. Here's the flag, the breakout. I'll just do a measured move right here, which goes up much higher. I think it goes up to 2,800 or something. If gold's breaking out now, so this is telling me, if in the past, it's telling me that the DXY should start going down. But if it doesn't go down, at the very least, the inflation adjusted DXY is going to go a lot down right here.
Yeah.
So it's kind of helping Forex traders, Vivek. So anybody who wants to know if they should hold US dollars or not, or hold commodities, gold long commodities, short US dollar, gold's giving you the clue to where the odds are. That's why I like calling it weight of evidence, where the probabilities are of the next foreseeable future. And guys, even for day traders, because you have to understand this, I call this the tsunami or the macro tidal waves, because everybody's not a victim, but all the instruments, when they're subject to their environment. And this is the financialization of all the environments where the capital flows are going. It's like a train track, when you put on the switch. Are they going in value, commodities and whatnot, hard assets, or are they going in growth? If you're on the short term and you're a day trader and you're trying to go long US equities, but you know that the capital flows on the long term, they're not going in US equities, you're playing with fire, because at any moment, the huge amount of selling of these guys, I don't know, these billionaire hedge funds, they're not going to buy overnight. They're going to keep buying. They could come in and buy, and they're going to destroy your trade. You're not putting the odds in your favor. So if this is actually a good scenario where you could probably want to short rallies in US equities, which maybe not now, because I'll show you maybe at one chart where I show you where the turn is happening for gold versus US equities.
Yeah.
But this is it's telling you that commodity rallies now the dips will start getting bought. So day traders, swing traders, if you want to do something with commodities, instead of trying to short sell commodities when they're about to do a correction, you should actually wait and buy the dip on the way up, because all these dips that you have, look at this, I'll put this long-term trend line, all these dips for gold, they were buying opportunities to add, right? And each of these shorts, they got destroyed because you kept doing higher highs. All these shorts, anybody who's tried shorting here, unless you're super nimble day trader, you just don't have the odds in your favor at that stage.
Got it.
I'll show you. Okay, this one. I'll have to find it. Give me 2 seconds. I'll find this chart, because this one is really, really critical. Did I put it here?
I'm going to discuss with you gold and US equities, gold and crude oil, and gold and base metals. And obviously, then we will discuss silver. So much I have to discuss. And if you can throw some light on crypto, whether there is a relationship.
Oh, man. There is one. I had to find it because there was so much fear of missing out when Bitcoin was 65,000. I said, Patrick, what's wrong with you? But then I found what it tracks. Okay, these are all the commodities, but this chart, this one is key, Vivek. This guys is okay. First, I'll start explaining. So, guys, whenever you look at a chart, first thing your reflex should do, if you look at the time frame, so this is monthly, and then after that, you look at the scale to see if it's log or linear. The black line is gold divided by SPX. So essentially, the ratio chart is telling you if this is going up, gold is favored versus SPX. So capital flows are going to gold. That's when you want to buy the dips in gold and short the rallies in the US equities. When it goes down, it's the inverse. That means capital flows are going to SPX. So it's a bear market for gold. It's a bull market for US equities. But then look, I overlaid the silver chart, Vivek, and this is insane. Two things, three different instruments, but one of these charts is tracking to perfection or very close a ratio chart of gold versus SPX. So this is telling me that the silver price is financialized. Forget, guys, comics, the manipulation. Essentially, silver is a victim or is subject to the macro environment of the financial landscape. So if money is not going into gold, so it's not going in hard assets, it's not going into inflation protection, that means there's no money that's going to go in silver. Even if you have the best mining company in silver, you're just betting against a trend because the money is not going in. And that's why, Vivek, sometimes even bad stocks, they go up in bull markets, because if fundamentals were so correct, why are bad stocks with bad management going up? That doesn't make sense. It's all about capital flows. So right now, as a chart trader, okay, fine. So I know that silver tracks very well the capital flows from US equities into gold. I have my super duper cool 7-year rate of change at the bottom. And look where we're at today. Here was the 1960s, late 60s. Here's 2002. Look where we are again. It's insane, Vivek. So gold is about to outperform. The momentum of gold is about to go in bull mode versus SPX. This is huge paradigm shift type of event. So even here, I drew a trend line, descending trend line here for the gold to SPX ratio. And you see the momentum closed above the 7-year rate of change before that long-term trend line was broken. Here's 1, 2, 3. Here, the momentum is about to break out. The momentum is front running the actual descending trend line breakout of gold versus SPX. This is a slight edge we get. The ultimate confirmation, of course, is going above, but this is giving me high conviction that unless this fails, it's a new bull era for gold. And we saw it in the Indian, like the gold expressed in the Indian rupee, right? Yeah. Is that how it's pronounced? It's the rupee. You saw how it's breaking out, right? The momentum. Yeah. You saw it even for gold. So now you're putting all the pieces of evidence of the whole gold complex, the precious metals complex. Gold's breaking out on the price chart. In US dollar, it's doing the same thing in Indian rupee and Turkish lira. All of them, they're all losing versus gold. We see gold's beating the minimum wage. Purchasing power is getting diminished, more and more inflation. And then you see that the capital flows. So all that huge amount of money, man, look, Vivek, I talked to one of my friends and he showed me these IPOs in the NASDAQ about a year ago. Even there's no profits, there's nothing. They're valued at billions of dollars. It's insane. And you look at these mining companies, 50 million, 100 million, even $1 billion company in the mining industry is huge. It's like the room is so small that as soon as the capital flows are going to start shifting just a little bit into precious metals, you're at the beginning, you get the huge amounts of percentage gains being positioned early. Because remember, on the log scale, if you go from $50 million market cap to 100 million, that's 100% gain for you, even if the company goes up only 50 million. But if you buy it much later in the rally, so a $1 billion company, for you to do 100% gain, it has to go to 2 billion. So that means one extra billion has to go in that market cap. So it's harder and harder. That's why these momentums, they always fail eventually. People get greedy, but it's hard to double all the time. It's just that the numbers, they don't make sense anymore, and you can't double at the pace. So to make huge gains, you want to get positioned here, here, and here. And this is another type of area where, so even if this turns down, it wasn't wrong to start preparing yourself because the low risk is here. And here's when your mom and dad and your best friend, your neighbors are going to tell you, hey, Vivek, you got to buy some gold. Then you say, no, I'm sorry. It's we've done the run. It's time. You'll know it'll be time to sell. And look, these runs are exactly 7 years. I don't know if there's a magical number in India, if you guys, you're into numbers, but this is pretty astounding that these peaks to valleys, the peak to valleys, the unwind of the momentum is exactly 7 years. Exactly. I have no explanation for this. So it's just an observation. This is we're quite lucky, but it's kind of sad at the same time, because if gold goes up, I've shown the chart, that means your purchasing power is going down. And if you don't have money already to be able to leverage it, to protect yourself, for those minimum wage earners, it's very, very difficult. It's kind of sad a little bit, because they have to spend their money right away to buy the food. They don't have any money to put on the side to try to leverage these momentum plays. So it's kind of, it's tough.
Sure. So because you are showing silver chart and gold also, so let me take the liberty to ask this question, that if suppose market does go up from here, then which one will outperform, gold or silver?
Silver will outperform gold, and we have a classic. The classic relationship for that is the gold to silver ratio.
Yeah.
So gold opens the gateways, and after that, here I'll remove all drawings, remove all indicators. Gold opens the gateways, and after that, it's everybody's turn in the commodity complex to have fun. Here is the 200-year, 100-year gold to silver ratio chart. So I like putting, here's let's say about here, maybe here. Sometimes, I try not to use the peaks. It's fine, the peaks, but what I find more valuable is pivot lines, where there's multiple reactions from above and below, Like I said at the beginning, it's kind of like a zone. So for new guys in chart trading, don't worry about it if it's not a perfect fit, but you'll see eventually where the price action reacts a lot. That means it has importance. Gold was pegged here, so this is kind of less. So all these areas here, that means silver, gold silver ratio. That means silver is very, very undervalued versus gold at these extremes. And when you hit the bottom of the rail, that means silver is very overpriced versus gold. And since this is an oscillator, usually ratios, unless you're measuring them against something that's continuously depreciated, like a fiat currency, they have a tendency to not go in a channel upwards. They oscillate, right? You compare one versus the other. So here you buy silver, and until this bottom line hits here, Vivek, and this is from 1970. I like comparing a lot, because before 1971, it's kind of like, before things weren't as financialized, because we were still on a gold standard. You buy silver here, you could still own gold, but you could have a lot of more silver until it comes down to this area here. So when the ratio comes down here, you could start swapping your silver for gold.
Sure. And is this ratio most of the time mean reverting?
You mean, let's say I have a moving average in this?
I mean, what I'm saying, that will this always go up and then come back again to the mean? Is it always mean reverting, just like a Bollinger Band?
Well, I'm not the mean is for you like the moving average, right?
The mean is the midpoint where typically the ratio remains there.
Right here.
Yeah.
So this would be the mean?
Yeah.
And you see the mean kind of reacts, right? So 82, this is the distances are pretty, let's do the distance here. That's 18 points. 15, 16, yeah, it has a tendency to come back in the middle. And lines, they love getting tested. So you see even here, the mean, I'm not quite sure where I put it around this area. Sure. We'll see that it gets tested a lot here, a lot of reaction areas. Here reacted, here a few reaction points, here before it went up on the other side. here another one, and here another reaction. And this, yeah, it looks like it's going to try to go for the hit that line once again, Vivek, the mean.
Sure. Sure.
Here you have the back test, a pure breakdown line. Lines love getting back tested. Often people, they see a breakout or breakdown and they put everything in, but guys, don't worry. Usually within 1 to 3 months, there's a back test because the markets, they like retesting. Like, am I really sure about this move? And people have, and if the back test holds, then you're short. So right here, that was this last great opportunity to go long. Well, maybe there will be another one. Depends how much we back test. But right here, that as this is turning back down, this was probably another great area to add silver versus gold right here. And this is the play. You play. And even here, when we hit this line here, sure, you could take profits. But if you close below this line, then you know the next target is going to be somewhere down here.
Sure. Got it. Let's talk about the wild relationship between gold and crude oil.
All right.
The friendly and not so friendly relationship. People do say that crude goes up, inflation goes up, gold should go up. But at times, crude doesn't want to accept this relationship. Or maybe you can prove me wrong that no, that's always the case.
Well, we know that gold likes to front run all the whatever crude oil happens, right? So let's say, I think I might have had a chart on this, but well, we could try to prove or disprove this with, we're doing live. I'm pretty sure I've done a chart with this. So okay, this is perfect. So let's say I have a theory. A theory usually it's a question. So your question is, can we prove or disprove a relationship between gold and oil? Hold on, I'm just going to move this to new pane below. I'm going to put this on the log scale. And guys, if you have difficulty choosing between log and linear, usually log is because you're adding zeros. It's moving in order of magnitude. And especially if a chart, you see it's all squished here and you can't really do technical analysis on it. That's because the price action over time has moved logarithmically. You see from 200 to 2000, and you're better off putting in log to be able to see.
Sure.
On a ratio chart, usually it's supposed to oscillate, so it should be linear. But sometimes when you have huge spikes,
yeah,
kind of move logarithmically. So you can cheat and put it on the. So this is my first instinct is to see where the range is, where, like you say, like the mean, where the middle is. And then I like putting areas where gold top and see what was the reaction of the ratio when that happened. So what can we deduce here? When the ratio went super high, that means gold was outperforming US oil to extreme. And I think this is when oil probably went negative, right? Look at that. Gold actually topped when this ratio was super, super high. Here's another region where the ratio topped.
And how do we take advantage of this? That what kind of position I can build? Because these are all monthly charts. So only valid if someone takes a longer duration position, which can only happen through derivatives, right? So how do I trade using this information on probably, if not intraday, at least on a daily basis?
Fine. So it's always forest to tree approach. So let's say you're a day trader, fine. Go, it takes 2 seconds. Go on the monthly chart. Now you see there's a breakdown for gold versus oil. So right now, it doesn't mean gold's going to go down, but oil should outperform until this goes back up. You should actually be going long oil right now. Oh, it could stop there. So I'm not quite sure where it's going to stop. So there's 2 roadmaps. But when this broke down right here, you could have went, okay, I'm going to go long oil. And then after that, you would probably, if you want to go on the smaller time frames, as soon as there's a pullback in oil on the smaller time frames. So let's say XLE. Then I would put my daily chart setup. I'll put the hollow candles. So right here,
what do you have in your daily chart setup? It's 50 MA and 200 MA, which you follow?
Yeah, exactly. It's pretty standard one. And look, there's another thing in TA. These are like the generic ones that everybody looks like, the 50s for faster reaction. But what I've learned is every instrument follows its own beat. So it's possible that what I would do here, you see the 200 reacts properly, right? He reacts here, bounce down, the 200 here. Yeah. But I could have played with it. I could have put the 200-day moving average, and it's not hard coded. That has to be 200-day, right? But you adapt the moving average. I could have went here in the little gear, and I could have played with it, and to try to make it best fit. And that's how TA should be. You should really observe the price behavior of a specific instrument, and then even here it seems to react a little better. The touch is less protuberance, and even here you see these spikes. They're contained. So maybe here, even a 225-day moving average, I see here it contains a price action, contains. Here it goes up, contains. So if I know, I look at that ratio, it's better to go long oil, the one on the monthly chart versus gold. Then I know that each of these dips that come and touch that 225-day moving average, I should be buying these instead of selling them. But if you don't want to buy catching a falling knife, you always do regular TA, guys. So get yourself a trend line right here. 1, 2. This is a bullish, expanding, descending wedge. People think this is bearish because it's expanding volatility to the downside. But actually, that volatility going down, when it starts waning off, so when it can't do a higher lower low, it's actually a springboard. And then you get a reverse symmetry move on the other side. I love these. Once you start seeing them, Vivek, you'll see them everywhere. It's the fractal properties of reverse symmetry move. This is the fractal properties of human behavior. The exuberance of fear and everybody selling, it's the end of the world, oil sucks, all that stuff. It happens, and on the other side, and that's, if you understand the psychology of it, then you won't be scared when this happens. When you have a 1, 2, 3, 4, 5, this trend line is very powerful. As soon you see in the breakout, we like getting retested. It broke out, came back to do a hard retest, bounce on inclining support of that long-term 200-day moving average. As soon as it closed back above this descending trend line, which is now support once again, this was a great entry right here. And look, here's another bullish expanding wedge that's happening right here. Once again, increased volatility to the downside. Scalpers, or you could have probably taken an early position here, and then here on the clean breakout right here, you would have added here. So yeah, technical analysis works great. And why these patterns on the smaller time frames work is because on the higher time frame, the capital flows are favoring the oil sector, even versus gold, or oil was probably really beating. I'll do oil versus US equities. Because the biggest enemy of all this is you want to be beating the SPX, because if you can't beat the SPX, why are we looking at these other stocks, right? You want to always try to beat. So this is oil versus the SPX. I know, where are my lines? Hold on. Let me do one thing. What were the dates here? What I'm going to do, I'm going to compare WTI. I'll keep it on the same chart so we could overlay and really showcase.
Okay.
Oil divided by SPX. New price scale. There you go. Okay, here it is. So right below, this is the oil versus the SPX ratio. So if this is going up, that means oil is outperforming. Hold on. Move that up to clean that up. There you go. So even here, you had a breakout for oil versus SPX. So anything above here, any of these pullbacks in the sector itself for oil, these were probably by the dip areas. That looks like a blow off. That's crazy, the performance. Look, this is a bullish. Usually this is a megaphone, but usually this is bearish. It resolves to downwards. And when you have this expanding volatility type of patterns, when they break to the upside, usually it's a blow off top, something very violent. And this is what happened for oil versus SPX. It goes like that. Nobody believes it. And then it just does a blow off top. So I'm not quite sure this is sustainable. There might be a reversion to mean, or like I said, lines like getting tested. So oil could be cooling off right now versus US equities, as this needs probably to get retested at some point.
Amazing.
Yeah. So this right here, I like drawing lines, possible roll maps, because for a valid trend line, you need three bounces. So here could be an area I could anticipate maybe a bounce. There's a more aggressive line that's right here. If that one falters, this line right here falters, then if it can't bounce up or consolidate here, oil versus SPX, then the capital flows will once again go back towards the SPX. So use ratios, use higher time frames, make sure you're aligned with it, and then have fun day traders buying the dips in this uptrend. And then you'll have the odds on your side, guys.
But say, for example, they're using so many ratios and 2-3 ratios give a conflicting view. For example, say between gold and SPX, you get a view that equity market should go down, and oil versus SPX, you get the opposite view. What do you do in that situation?
Well, yeah. So you have to see always the instrument you are, what sector does it belong to? So the first tree is on the time frames, so the yearly, monthly, day, all the way to daily, but also on the way up. So you see here the XLE is the inside of that. There's probably oil miners. The oil miners are part of that sector. That sector is under the tutelage of the oil price itself. But oil is also a commodity. So oil will go to it's in the PPIA, all commodity index. It's in here. So let's say I remove all indicators. So this is the PPI, and gold is in there also. Everything's in there. No, this is the granddaddy. So if you want to make a decision based on, I'll do PPI. So now you go ratio, but from the parent, not the stock, not the industry, not the sector, this is the equivalent of the index for commodities. And then I would probably want to compare it to SPX or the Dow Jones. And I'll put it on the monthly. If this reset chart, if this chart is outperforming Dow Jones, then even if I have conflicts, because the conflicts, as gold opened the gateways for commodities versus U.S. equities, they can't go up in a straight line, right? So when one pulls back, then after that, it's a turn maybe of another commodity to go up. Then when oil cools down, it's still in the bull trend maybe versus U.S. equities on the long term. Then another sugar could go up, wheat could go up, and they all go. It's like a sinus, sinusoidal type of curve, and they all go, but they at different wavelengths. This is the granddaddy of all charts. So if the commodities, since like 1932, here, here is one. This is a pretty clear break. So here was the bull market for commodities. Oil went crazy in the 70s, maybe not the same time as gold, but they both, we know that from the beginning of when this ratio started turning up to the end of it, both gold and oil and silver, they all had great runs, right? Here's another one. Here's beautiful double bottom above, right here, consolidating above that EMA. So even if the rate of change is negative for commodities versus US equities, you still knew that you were going to have a cyclical run up for commodities in a secular downtrend for commodities versus Dow Jones. Because it's funny, because when you look at this chart, you clearly see that commodities have been losing versus US equities since ever. But this is interesting. Oh, I just look, this is a falling wedge, Vivek. Wow. I've never seen this before. So if this breaks out, the target of falling wedges is the beginning of the pattern. So this again is another this is more clues. The volatility, the commodities are losing less and less, and you see in the rate of change, right? The momentum, even if it's going down, it's not going down as fast. The lows are not as low. So you see, here's the low went down 69%. Here, the lows went down 41%. They're not going down as fast. The momentum is winding down. That's how you start covering bottoms. And look, it's above the EMA. If this has enough juice to get back above this line here, maybe here's, it seems to be some resistance. The target of a falling wedge is the target. So this is more weight of evidence that if this breaks out, all the other charts that we saw, all the commodities should be in a bull market, at least until, and if you don't want to get greedy, because of course this will not go up in a straight line. This is a great tool. Use this, guys, all the time, because whenever I give a target, somebody gives a target, oh, gold 7,000. In their head, they see a straight line, Vivek. And as soon as it goes down 300 or goes up 500, they start doubting. So the best thing is your brain for visual input, here, this one here. So your brain could kind of see what's going to happen here. See, I'm going to hit this line. That's probably some resistance. I might go down a little bit. Then I'll break out. I'll hit this line, which is previous support, now turn resistance. I'll hit here, retest. I'll go up here, test that line, which is the previous high. I might go do a bull flag here. So if you're able to visualize these bounces where they could go, then you're one step ahead. It's like a pool player playing billiard. He's already going to see the possible moves. It doesn't mean it's going to happen. You adapt. If this doesn't play out, you adapt. But look at all these reverse symmetry moves. The vacuum down. This is another concept. Because the faster the price action goes down, there's not many buyers buying on the way down. It goes down so fast, right? So all the bag holders that bought at these prices, they're not there on the other side. So once you're out of a base, and that's when remember chart traders, they always say this, the bigger the base, the higher in space. Well, whenever I say base, it breaks out. I always look on the other side. The angle of descent is usually mimicked. Look, you see it here, Vivek, right here. It's look at that, the base. If I would put an angle, I'll put my angle tool. Where's my angle, guys? How come I don't know trading view by heart? I should. Here's my angle tool, 68 degrees down. And on the way up, I'll put 68 just to show. It went up even faster. You see, a reverse symmetry move. And since we were in a long-term downtrend, we weren't able to continue all the way up here. But if it would have broken up here, then we say, okay, the trend is starting to change. And so here's my move. I'll take another line here. And if ever we close above this line here, then after that, my next target would be here, etc. And then we build. See, look at the reverse symmetry move. So here, this is a huge base. Touch here, neckline, touch here, consolidate. And then after that, you're probably reading my mind. Yes, Vivek, this is the final reverse symmetry move someday. Yeah. I don't know when. I don't know. But someday, if this falling wedge is to fulfill its destiny, this is a type of reverse symmetry move we should be expecting, which is kind of, maybe this is more logical. You see this rising trend line? Maybe that's what's going to happen.
Very interesting.
And you have the rate of change supporting this thesis that, look, it's higher lows, lower lows on the PPI versus Dow Jones. But look at that, the rate of change refused to do a lower low. This is huge, especially on the monthly chart. So again, for day traders, guys, you should be looking to buy the dips, and you'll have higher odds of success than trying to buy the dips now in US equities, because the capital flows, they're just not going to be there as often, as long, as pronounced to help you have successful, meaningful trades.
Awesome. Patrick, just one request. Why don't you analyze Nifty chart for us?
Ooh,
It's a googly.
I think we're gonna have to do so many sessions because is this one? This is it, right?
Yeah.
Oh.
And there is one ratio which I will, before we end this one, Bank Nifty versus Nifty. That's a very famous ratio in India. Huh?
Okay, so let's check. Is there did the Nifty start in 1990? No, before,
yeah,
right?
almost there. Yeah, almost there. 1990.
So you've been in the momentum has been dwindling. This is a pretty big top. So the momentum, even this is what's tricky. Even if nominally the price action kept going up. So right here, price action kept going up. The momentum has not been able to go up as high. So you can't take this in a vacuum, right? You have to be careful because momentum could keep going down.
Yeah.
But right now, the momentum is at a decision point. If the momentum breaks out above this line, something crazy could happen in the price of the Nifty to upwards nominally.
Okay.
Even here, I could have a reverse symmetry move. So if this line breaks out, Vivek, this looks kind of bullish actually.
Okay.
So this would be my breakout line. A break to the upside, you go long Nifty nominally. It's expressed in the Indian ruble right here.
Yeah.
And if it breaks down, let me check that out. Hollow candles. I'll just change my setup here. I like you. Oh, it's doing pretty good. The Nifty, it's doing better than US equities. That's for sure.
Yeah.
It is, right?
It's not falling so much. I mean, Dow has fallen so much, but Nifty has not really corrected so much.
It's not even below the 1 year moving average. So there's a few clues that the momentum is slowing down a little bit. This trend line is broken. Doesn't mean you go down to zero, but the rate of ascent has definitely stalled. So this is my next step. Whenever I see a rate of change, a trend line break, then I say, okay, where's the possible next time I should get in? Because you don't know if you don't want to hold this, because just in case this goes and retests the 3 year moving average, for day traders, you don't want to hold all that time because there's opportunity cost. You should be in another asset at this time. So right now there's a signal that you should have taken profits on this trend line break. And then you wait for this trend line to break to the upside. If this one breaks to the upside, there's a good chance the rate of change chart that I showed you previously, that one also is going to break to the upside. And then you might have a meaningful, another meaningful rally in the Nifty.
Awesome.
What's the ratio you wanted, Vivek?
Bank Nifty by Nifty. Bank Nifty.
This one.
Yeah, by Nifty.
Oh, that one's breaking down. Interesting. Okay, let's do the 7 year rate of change. Do I have a lot of data? That's why I fell in love with gold and silver, Vivek. It's all the data. Like I can't even trade IPOs because of the data. The lack of data is I believe it hinders my capacities of correctly establishing the probabilities of these possible moves. Look, this is a rising bearish wedge that broke down and it's retesting the breakdown line. So this looks like the Nifty will outperform Bank Nifty. The target would be down here. The rate of change is kind of messy, but it did break down right here, and now it's below zero. And I'll use my other setup here with my 1 year and 3 year moving average. So below the def cross, retest the breakdown line. Below the cloud, the Ichimoku cloud is that green cloud, which is support. And support, you see how it holds it up here. And now it just fell through, retested. And now look, this is the line. This is my line in the sand. Until this line breaks down, this could be a bullish, expanding, descending wedge here, but you just don't know where it's going to be, right? You You don't know how low it's going to go. And in theory, the end game target should be down here. And of course, there's support levels along the way. But until this line breaks out, I would probably put an alert. Guy, trading view, add an alert on trend line, guys. That's it. Then go to bed, take care of your kids. And this line is pretty much going to track the 3-year moving average. I would not touch this, or that means go long Nifty or go short bank Nifty until this trend line here breaks to the upside. Vivek, what is bank Nifty? Actually, what is that?
So Nifty is India's 50 stocks in terms of top market cap, and Bank Nifty is banking stocks, top 7 or 8 banking stocks of India, which are, typically Bank Nifty is more volatile and it's a high beta than Nifty. So there are futures contract in Nifty and Bank Nifty. So there are weekly options contract in Bank Nifty. So a lot of people in India trade those weekly options contract. So that's why.
Got it. So that's high interest, high value chart for your viewers.
Yeah.
Well, here's my line in the sand. So don't go long until this breaks to the upside here, at least at the minimum, this line.
I guess I need to have one more session with you where I'll discuss all the 50 stocks someday with you.
It'd be my honor, because it makes me discover another stocks that I never look at. And it'd be my pleasure there to cover anything you want to go over there. Chart trading, guys, I love gold and silver, but a chart trader is any chart, and we get to work.
Awesome. Patrick, it was such awesome feeling to talk to you, get so much insights, and it was quite a new perspective you gave to us. And the way you use trading view is like butter. You're so used to that tool. Huh?
You need, it's like a mechanic. If you're new, guys, and you're trying to learn something new, if you're not good with your tools, you'll never be able to do a good sculpture. You'll never be able to do good painting. Get used to your tools and have fun. It was hard for me at the beginning. Click. Even today, I'm dyslexic, so I don't know. I can't find the stuff. But the best, get used to your tools, and the tools will leverage your ideas right away. You have an idea, you have the tools, and in 2 minutes, you get to see what's happening. So, practice, guys. Practice. No shortcuts.
That's true. Awesome. It was fun interacting with you. I hope to be in touch with you always. And let me see if I can plan one more session. I can get some more time from you, and it will be so much fun to get more insights from you about Indian market. Till then, thank you so much, Patrick.
A true honor. Thank you, Vivek.
Thank you so much.